Hello. In this video, we will be going over the retail method for inventories. So in a previous video, we discussed that high volume retailers might not be able to physically count all of their inventory, or they can't do it frequently. So they might only do it at year end, but they still need to estimate how much inventory they have throughout the year. And so when you have high volume retailers such as Target, Walmart, Costco, they need a way to estimate their ending inventory and their cost of goods sold. And so the way they do that is one of the ways is they use the retail inventory method to calculate those items. So one thing you should know is that companies, when they track their purchases, their inventory purchases during the year, they track it at a cost and retail price. And cost is tracked based on how much a company pays for their inventory, and retail refers to how much they believe they can sell that inventory currently. So companies track both those items whenever they have purchases of inventory. So if you recall this, you should be familiar with this slide, the cost flow of inventory. When we take the beginning inventory plus net purchases equals merchandise available for sale, or we call it goods available for sale. And those goods are split between your ending inventory, your cost of goods sold. And that has to do with the cost. So everything here that we've been talking about till this point is when we purchase our inventory or our beginning inventory, but let's talk about our purchases, we record it at what we paid for those purchases. However, companies also will track their purchases based on the retail amount, which is how much they think they will be able to sell that. And so therefore they have this beginning inventory number at retail. They record any purchases at retail as well. It's just a separate tracking. And then they have, I'll just call this goods available for sale at retail. So they so think of it as like two different sets of books almost but they can track it. And so this goods available for sale, right? Some of it we end up not selling, and so it remains in our ending inventory. And some of it we do sell, and that ends up being part of our sales. That's our sales number. So instead of cost of goods sold for the cost flow of inventory, we have a sales. So I'm going to go back to here of how can we estimate our cost of goods sold and ending inventory number that needs to be reported in our financials. So we take our beginning inventory at retail plus our net purchases at retail, which is from our current retail prices, gives us our goods available for sale at retail, less net sales, and that we have that. We record that all the time. Will give us our ending inventory at retail. From this point, then we will be able to convert this ending inventory at retail to an estimated ending inventory at cost, and then we convert it to an estimated cost of goods sold that we can use to book in our financials. And we're going to go through that of how to do that. So let's look at a very basic example. Home Improvement Stores, Inc. uses a periodic inventory system and the retail inventory method to estimate their ending inventory and cost of goods sold. And here's their data. And this is how we do it. We will look at two columns. We look at the cost and the retail column. And we begin with we're going to go through our formula, meaning beginning inventory plus net purchases equals goods available for sale. So we have our beginning inventory, the cost, and what we think we'll be able to sell it for, right? That's from like the prior year, plus our current year purchases at cost, plus what we think we'll sell it for, equals our goods available for sale at cost versus retail. So what we're going to do then is we're going to calculate a cost to retail percentage. And we're going to take our goods available for sale at cost right here, divided by our goods available for sale at retail price, 560,000, and that's going to give us 62%. So that tells us for every $1 of goods available for sale that we have at retail price, we're going to estimate it cost us 62 cents to get that good. So that's what that means. So then we're going to focus on this retail column. We have our goods available for sale amount. If we're going to just calculate the retail column, if we deduct net sales, then we can get to our ending inventory at retail. So we're going to reduce it by net sales for 400,000, which gives us an estimated ending inventory retail for $160,000. Well, we know based on this calculation, for every $1 of goods available for sale, it cost us 62 cents. And so we're going to apply that same methodology to our ending inventory. Whatever our ending inventory at retail, we're going to apply this percentage to it to estimate our ending inventory at cost, which is what gets recorded on the financial statements. So we're going to take that 160,000 times the 62%. That's the 160 times 62%, gives us our estimated ending inventory cost of 99,000. Now, I'm going to erase some of this stuff just so it's not as messy. But remember our formula of just basic formula for cost of goods sold is we take beginning inventory plus purchases equals goods available for sale minus ending inventory equals cost of goods sold. That's just the basic calculation we've been working with for many chapters. So now, because this is an estimated ending inventory at cost, this is also our estimated cost of goods. And that's how you can calculate an estimated ending inventory and estimated cost of goods sold. There are some very distinct advantages of the retail inventory method. And the first one is that it provides a more accurate estimate than the gross profit method. And that's because the retail inventory method is based on the current relationship between the cost and selling prices, whereas the gross profit is based on the historical profit ratio. So retail method is more current. The retail inventory method can also be applied to different cost flow methods. We can calculate in various ways that match the cost flow methods. It's not really used for FIFO. It can be, but most companies that have FIFO don't use it. So I'm crossing it out, but that doesn't mean it cannot be used. It's just highly unusual. And so usually companies that have LIFO or average cost use the retail inventory method. And just like the gross profit method, it can also be used to estimate the cost of like lost, stolen, destroyed inventory. It can be used in the budgeting and forecasting and interim financial statements. It can be used to test the overall reasonable of physical counts, be used by the auditors to see, does this seem reasonable? But usually, a physical count of inventory is still performed at least once a year to verify the accuracy and other things that we might not consider in the retail inventory method, such as spoilage and theft and whatnot. So there's some terminology that you should become familiar with when it comes to the retail inventory method. And think about when you go to buy an item of clothing, there's what's called an initial markup. So the company pays a certain amount of money for a shirt, right? That's what it costs them. and they sell it for a certain amount. That's the initial markup. There could be additional markups and then markup cancellations. There can also be markdowns and markdown cancellations. And I'll just go through a problem and we'll see all those terminologies in effect. So let's take an example that we bought, a company purchased an inventory item for $4 and they're selling for $10. So the difference is $6, right? That's called the initial markup, is the $6. That's the initial markup. Now, sometimes, things sell really well and there's not enough supply. So the company's store might decide, oh, I'm going to mark this up even more because I can make more money. So they mark up this $10 price to $13, right? And so that additional $3 between here and here, that's called the additional markup. Time passes and things are not selling as well at $13, and the company decides to lower the price to $12. Well, that's called a markup cancellation. This $1 reduction is a markup cancellation. Then when you calculate your net markup is going to be your additional markup plus, or I should say minus your markup cancellation. It's the 3 minus 1 equals 2. The initial markup does not go in there. That initial markup is already incorporated into your retail price. So just want you to know that. And also when you have markups, the final price is $12, whatever it is. It cannot go below the original selling price of 10 when you have the markup cancellations. Alternatively, you can have your selling price of $10, right? And so your initial markup is still $6, but your product is not selling that well, so you decide to reduce the price from $10 to $7. So you reduced it by $3. That's called a markdown, that minus 3. Well, you've been selling at $7 and it's kind of selling better than you expected. So you're going to increase the price a little bit to see if it still sells. So you're going to add $1 to your sales price. So now instead of $7, you're going to sell at $8. And that's called markdown cancellation. And that's the markdown cancellation is $1. So then you look at your net markdown, and that's a minus 2. So that's the negative 3 plus 1 is your net markdown. Again, your initial markup of $6 is already included in your retail price. So the original retail price. Also, this $8 right here cannot go above the original selling price of $10. That's just the nature of markups and markdowns. And when we calculate the retail inventory method, the net markups and markdowns have to be included in the determination of the ending inventory at retail. Let's go to a very quick example here. And this is the average cost retail method. Let me make this a little bigger. Here we go. It's a little better. And if you remember that the average cost method, when we do, versus FIFO or LIFO, assumes that the cost of goods sold and the ending inventory each consist of a mixture of like all the goods available for sale. And so when we use the retail method to calculate the estimated cost of goods sold, the cost to retail percentage that we apply to the ending inventory should be based on the weighted averages of those cost and retail amounts. So, and that's and you'll see that we just do a total for everything. So let's just go through this. This is the average cost retail method. And we'll start with our beginning inventory. It goes through our formula, beginning inventory. Now we have a cost and a retail column. We add our purchases, which is also a cost in retail. And then we have our markups and markdowns. And the markups and markdowns only go in the retail column. They do not go in the cost column because there are no markup and markdowns from for cost. We only have markups and markdowns based on our retail sales, right? Because that $10 in that example that I gave you guys, that was the selling price. That's the retail price. So it goes into the cost of goods available for sale at retail. From there, we take our cost to retail ratio, which divides our 140,000 divided by 388, and we get this approximately 36%. So now we have our cost of goods sold, cost of goods available for sale, minus, if we take less, our net sales, right? We'll get our estimated ending inventory at retail. And if you look at this formula takes the goods available for sale, the 388, minus the net sales of 50. That's how we get 338. Now we look at our cost to retail ratio of 36%, and we apply it to this estimated ending inventory at retail. And the 36% times the 338,000 gives us our estimated ending inventory at cost for approximately 121,000. Now going back to our formula of how we calculate cost of goods sold, we have our beginning inventory plus purchases equals our cost of goods available for sale minus right here our ending inventory at cost equals our estimated cost of goods sold. That is the average cost retail method in a nutshell.